it's just like the mother of all brutal curriculum. I mean, it's not like liberal arts were sliding through, is it?
No, and I had to write a thesis before I graduated, no matter what you wanted to do.
What'd you write it on?
Honors.
Scott Bessett and Operation Twist?
So I wrote it about early modern English financial history. So like William of Orange coming over from the Netherlands, taking over from Cromwell, building out a central banking system, purely so that I could talk to a recruiter and convince them that I was interested in working in financial services. Exactly.
I got a liberal arts degree, but I need a job.
Yeah, exactly.
Well, let's pick up on that as well. Bank of England, hugely original until its recent independence, and the hallmark of Bank of England, where you wrote your thesis. I hope Jamie Dimon's listening to this. So the hallmark, Jack Manley, where you wrote your thesis was Dissent. BOE owns Dissent. Are we going to see the same Bank of England Dissent under the Warsh Fed?
I think we probably will continue to see dissent under the Warsh Fed. But I don't know if it's going to be from Warsh himself or the members of that open market committee. I think that's going to be the big question.
I should mention, Paul, I got a glimpse of my schedule at Jackson Hole. Yeah. I believe I have the honor of speaking with Catherine Mann of the Bank of England at Jackson Hole, which is wonderful.
There you go. What'd you make of our Treasury coming in yesterday and I guess buying back some bonds and stuff?
Yeah,
What's going on there?
Well, I think buying back some bonds is a pretty good way to think about it.
No, we care. We care. We're sensitive. Was Kelsey Barrow medicated? Did you have to take her?
I do have to check in with her, make sure everything's okay.
You had to take her down to Dangerous Provisions and make sure she can get
I'll make sure she's all right. Yeah, I mean, we were talking about a $30 trillion bond market. A couple $billion here or there is a drop in the bucket. It is much more symbolic than anything else. What matters a whole lot more is the announcement earlier this year of that $40 trillion milestone on the debt. That's going to matter more, I think, for Treasury yields than anything the Treasury is doing, at least as of right now.
Rates moving higher. Why are rates moving higher around the world, do you think?
I mean, I think some of it just has to do with Japanese yields moving higher and that functioning as kind of the floor for how most developed market yields are priced. I think there's a lot of concerns around AI CapEx and the borrowing that's going into that. I think that there is obviously a fiscal problem in the United States that we just talked about. Then there is, as I believe we mentioned earlier, concerns around inflation. But when I think about all those things, funnily enough, the thing that doesn't bother me as much is the inflation concerns. Talking about what's going on with oil prices, obviously elevated uncomfortably so. But I have a very hard time imagining, A, how those higher oil prices are going to bleed into broader inflation, especially over the long run. And then B, even if they did, how higher interest rates are going to do a whole lot to solve it. So I think that's the one kind of piece of the puzzle that doesn't belong where it's been placed. It's the one thing I don't necessarily buy into.
Tom Keene, Lisa Bromwitz, Michael McKee, they're heading out to Wyoming or somewhere, some horse farm. I don't know. They're going to be riding horses. But apparently some economists are heading out there next week. What do you expect to hear from Fed Chairman Warsh next week?
I think we're going to hear a whole lot of nothing, to probably oversimplify things. I mean, Warsh has made it extremely clear that he wants to hold the cards as close to his chest as he possibly can. He is not particularly interested in forward guidance. Remember, he sat out from that SEP at the end of June in the second quarter. I think it's going to be a lot of cryptic talking. I think we'll probably get an update on where those task forces are and how that progress or how those things are progressing. But don't expect a whole lot of clarity on what the Fed's going to be doing over the next 12 to 18 months. That is not Warsh's story.
Global market strategist, JPMorgan Asset Management. Where are you telling people to go these days?
So I get kind of conflicting messages here because I am the biggest believer in U.S. equity exceptionalism, at least on the market insights team at JPMorgan. And I continue to believe that a significant overweight to U.S. stocks is warranted if you're a long-term investor. I am simultaneously a little bit concerned about how deep this AI trade has gone and how limited the return on investment has been up until this point. And while I don't typically think tactically, we are longer-term investors. We like to think about the next 5, 10 years. If I do have to put on my tactician's hat and think about what happens over the next 6 to 12 months, at some point, you got to make some money in this stuff. And so we're having more conversations about true global diversification. And to me, what's so amusing is that the biggest liability, the biggest reason to not invest in Europe or Japan or so many other higher quality developed markets over the past 15 years, basically lack of exposure to anything exciting, innovative, dynamic, tech, AI, like what the U.S. has, it's now become an asset. it's now become a reason to invest in these markets because it's one of the only places where you can actually
Right.
hide from that AI
But
concentration.
then where does currency play in? I mean, just this morning, you're seeing this phrase, dollar debasement, which you get out of interest expense and fiscal unrest. Currency adjusted, how will American investors do?
I actually believe that currency is going to be a net neutral over the course of the next 12 to 18 months. I never really bought into the declining dollar narrative. I mean, yes, there are plenty of reasons why the dollar could be argued to be overvalued. There are plenty of reasons why you could argue the opposite. And when we think about certain fiscal problems, when we think about inflation issues, when we think about rate differentials, when we think about the trade deficit, yes, there is downward pressure on the dollar. At the same time, though, when we think about growth potential, when we think about equity market attractiveness, and when we think about geopolitical risk, all those things are dollar positive. And it's too hard for me to assign like a value to any of those, to assume which one's going to outweigh the other. I'd rather just kind of have them all come out in the wash and say, I don't really think the dollar is going to do a whole lot. But I think of it as being a neutral factor more than anything else for most U.S. dollar denominated investors.
I'm sitting on the sidelines here, and I'm clipping 4.2% coupons for my 2-year U.S. government bond. And I think the government's going to pay me back in 2 years.
I hope so.
Do I take credit risk above and beyond that? Am I going out there and buying some of these hyperscaler bonds that I know you guys are loading up on at JPMorgan?
I am a coward in fixed income. I just don't do it. I don't buy bonds to juice my portfolio returns. You know, when you're looking at strong fundamentals and an equity market that's done double digits for the past 4 years, I'd rather get my high octane stuff out of stocks and buy those bonds as ballast insurance.
Okay, let's go back, not to William of Orange, but to Donald of Orange. Let's look at the crises in this arch idea with quiet money. Can you see the crisis coming? If I'm allocated optimistically, do I have the ability to get out when it snaps? I don't see a successful history of that.
No, I mean, being able to time something like that would be almost impossible, which is why we are having, again, more serious conversations about diversification than we've had in a very long time. I think fixed income plays a more important role in portfolio construction than it has in 15 years because A, coupons are high, right, as you mentioned, but also B, the macro outlook is still a little bit shaky. We don't really know what's going to happen. While I don't think there's a recession, there might be, and if there is, that's where duration helps to kick in, where quality helps to kick in. On the equity side, we talked about being globally diversified. I think there's a real push for active management, bottoms-up security selection, really knowing what you own in that space. You have to put your chips all over the place. Excuse me, to hedge against these risks.
You love this. It's so topsy-turvy now. This is Ambrose Evans Pritchard out of the Telegraph. I'm reading Barbara Tuchman's The March of Folly, which I've read before, but just to redo the madness of where we are right now.